morning. I'm Jim Dorn, Vice President for Academic Affairs at the Cato Institute. It's a pleasure to welcome you to Cato's 15th Annual Monetary Conference. This year's conference is being broadcast live to London, New York, Chicago, and Dallas via satellite, and to the rest of the world via the internet. So I'd like to extend a special welcome to all our friends outside the Beltway, because I don't think we have too many inside the Beltway these days. I've had the good fortune to be able to direct Cato's Monetary Conference over the past 15 years. Cato's first conference in 1983, the Search for Stable Money, set the stage really for questioning the status quo in the field of money and banking, and returning to fundamental questions about the nature of alternative monetary regimes. The emphasis has been and is on institutions. That is, on the rules of the game rather than simply on those playing the game. While we can congratulate Alan Greenspan for doing a fine job in controlling inflation, that should not blind us to the fact that we still live in a world of government fiat monies with no anchor except government itself. The search for stable money is important because sound money lubricates the market price system and promotes sound banking. When central banks permit excessive monetary growth, which must later be corrected, they not only harm economic growth, they endanger economic freedom. In a free society, people ought to be able to choose their monetary institutions and be able to experiment. That's why Nobel laureate F.A. Hayek, after whom this auditorium is named, argued for private alternatives to government fiat money. In his view, competition is superior to government monopoly over currency. The information age offers an opportunity to experiment with electronic currencies and electronic banking. Last year's conference was devoted to the future of money in the information age. And a book was published with that title, which is available from the Cato Institute. This year's conference, Money and Capital Flows in a Global Economy, considers the policy implications of globalization and digitalization of money and capital. The information age, financial innovation, trade liberalization have increased the mobility of capital and given individuals greater choice. As a result, governments everywhere are under pressure to move to the market and to respect property rights or face the prospect of low capital inflows or massive capital outflows. Inflationary policies and costly taxes and regulations undermine private property rights and discourage investment. Malaysia's Prime Minister Mahathir Mohamad may blame George Soros for his woes, but as New York Times columnist Thomas Friedman wrote, quote, "The most fundamental truth about globalization is this: no one is in charge. The global market today is an electronic herd of anonymous stock, bond, and currency traders sitting behind computer screens," close quote. That's why regulation of the global market is virtually impossible, and why central bankers cannot dictate the value of foreign currencies. If economic policies are in conflict with the fundamentals, speculators will win hands down every time. The trend of less developed countries to adopt currency boards and the trend of developed countries to increase central bank independence and to adopt monetary rules such as New Zealand's inflation target rule stem in part from the forces of globalization and digitalization that make policy mistakes extremely costly. At today's conference, we begin with Alan Greenspan and end with Walter Wriston. In between, you'll be treated to panels dealing with how to avoid international financial crises such as those that have plagued Mexico and more recently Southeast Asia. Also, policy options in a world of mobile capital and the future of money and central banking in a global economy. Our featured luncheon speaker is John Rutledge. It should be an intellectual feast which I hope you will all enjoy. Now Ed Crane, president of the Cato Institute, and the person who has made Cato's annual monetary conferences possible, will introduce our keynote speaker, Alan Greenspan. Thank you very much.
Thank you, Jim, and congratulations to Jim Dorn for the excellent job he's done in putting together another great monetary conference, which we've come to expect from Jim over the years. I'm going to keep my comments very brief because Chairman Greenspan does have a plane to catch, and I know you're here to hear him and not me. I do want to send a special welcome to John Blundell and our friends at the Institute for Economic Affairs in London. And I would briefly mention to that group that the Cato Institute and The Economist magazine will be co-sponsoring a conference December 8th and 9th at the QE2 Conference Center on the international public pension crisis. This is going to be a terrific conference. There are speakers from 14 countries who will be in attendance, including Frank Field and Peter Lilly of Great Britain, Gary Becker, the Nobel laureate from the United States, Sun Zhengyang of China, who's a senior official there, interestingly enough charged with the responsibility of trying to set up a Chilean-like individually capitalized Social Security system. You can imagine the significance of that. Also, Jose Pinera will be there, and he, of course, is the architect of that very successful Chilean pension experiment. For information on the conference, our British friends should visit the Cato Institute's Social Security website, which is www.socialsecurity.org. I was very pleased to see as well that Alan Greenspan and John Kasich both had positive comments to say about Jose Pinera at last week's House Budget Committee hearings. Dr. Pinera is co-chairman of Cato's project on Social Security privatization, which I think is an immensely important undertaking. We are honored this morning to have as our keynote speaker for the Cato Institute's 15th Annual Monetary Conference the chairman of the Federal Reserve Board, Alan Greenspan. Chairman Greenspan has been a good friend of the classical liberal movement in America for many decades, and in fact was a featured speaker at one of the Cato Institute's very first conferences held in New Mexico back in 1978. He has since visited the Institute and our events on a number of occasions, and we're pleased to welcome him back again. I won't take time here to explore Alan Greenspan's many accomplishments and his distinguished career, including, of course, being named chairman of the Fed back in 1987, because he is literally a man who needs no introduction. But I would point out that while one can debate whether or not we are in the midst of an economic paradigm shift in which technology will propel us ever forward, there can be no debate but that the stable monetary policies of the Fed over the past decade have contributed immeasurably to the outstanding economic performance of that decade. It is with not a trace of irrational exuberance that I say our speaker this morning deserves the lion's share of the credit for those stable monetary policies. Ladies and gentlemen, it is a pleasure to introduce our keynote speaker, the chairman of the Federal Reserve, the Honorable Alan Greenspan.
Thank you very much, Ed. You may have thought that when Jim was saying that the program will start with Greenspan and end with Wriston, as though you're getting a really wide spectrum of opinion, you're going from A halfway to B. What I'd like to do this morning is to put in context the development of global finance and to try to raise a number of issues which relate to the program in general. As you all know, as a result of a very rapid increase in telecommunications and computer-based technologies and products, a dramatic expansion in financial flows, both cross-border and within countries, has emerged. The pace has become truly remarkable. These technology-based developments have so expanded the breadth and depth of markets that governments, even reluctant ones, increasingly have felt that they have little alternative but to deregulate and free up internal credit and financial markets. In recent years, global economic integration has accelerated on a multitude of fronts. While trade liberalization, which had been ongoing for a longer period, has continued, more dramatic changes have occurred in the financial sphere. World financial markets undoubtedly are far more efficient today than ever before. Changes in communications and information technology and the new instruments and risk management techniques they have made possible enable an ever wider range of financial and non-financial firms today to manage their financial risks more effectively. As a consequence, they can now concentrate on managing the economic risks associated with their primary businesses. The solid profitability of new financial products in the face of their huge proliferation attests to the increasing effectiveness of financial markets in facilitating the flow of trade and direct investment, which are so patently contributing to ever higher standards of living around the world. Complex financial instruments, derivative instruments in one form or another, are being developed to take advantage of the gains in communications and information technology. Such instruments would not have flourished as they have without the technological advances of the past several decades. They could not be priced properly, the markets they involve could not be arbitraged properly, and the risks they give rise to could not be managed at all, to say nothing of properly, without high-powered data processing and communications capabilities. Still, for central banks with responsibilities for financial market stability, the new technologies and new instruments have presented new challenges. Some argue that market dynamics have been altered in ways that increase the likelihood of significant market disruptions. Whatever the merits of this argument, there is a clear sense that the new technologies and the financial instruments and techniques they have made possible have strengthened interdependence between markets and market participants, both within and across national boundaries. As a result, a disturbance in one market segment or one country is likely to be transmitted far more rapidly throughout the world economy than was evident in previous eras. In earlier generations, information moved slowly, constrained by the primitive state of communications. Financial crises in the early 19th century, for example, particularly those associated with the Napoleonic Wars, were often related to military and other events in faraway places. An investor's speculative position could be wiped out by a military setback, and he might not even know about it for days or even weeks, which from the perspective of central banking today might be considered bliss. As the 19th century unfolded, communications speeded up. By the turn of the century, events moved more rapidly, but their speed was at most a crawl by the standard of today's financial markets. The environment now facing the world's central banks and, of course, private participants in financial markets as well, is characterized by instant communication. This morning, I should like to take a few minutes to trace the roots of this extraordinary expansion of global finance, endeavor to assess its benefits and risks, and suggest some avenues that can usefully be explored in order to contain some of its potentially adverse consequences. A global financial system, of course, is not an end in itself. It is the institutional structure that has been developed over the centuries to facilitate the production of goods and services. Accordingly, we can better understand the evolution of today's burgeoning global financial markets by parsing the extraordinary changes that have emerged in the past century or more in what we conventionally call the real side of economies, the production of goods and services. The same technological forces currently driving finance were first evident in the production processes and have had a profound effect on what we produce, how we produce it, and how it is financed. Technological change, or more generally, ideas, have significantly altered the nature of output so that it has become increasingly conceptual and less physical. A much smaller proportion of the measured real gross domestic product constitutes physical bulk today than in past generations. The increasing substitution of concepts for physical effort in the creation of economic value also has affected how we produce that economic output. Computer-assisted design systems, machine tools, and inventory control systems provide examples. Offices are now routinely outfitted with high-speed information processing technology. Because the accretion of knowledge is, with rare exceptions, irreversible, this trend will doubtless continue into the 21st century and beyond. Value creation at the turn of the 21st century will surely involve the transmission of information and ideas, generally over complex telecommunications networks. This will create considerably greater flexibility of where services are produced and where employees do their work. The transmission of ideas, or more broadly information, places it where it can be employed in maximum value creation. A century earlier, transportation of goods, usually by rail, to their most value-creating locations served the same purpose for an economy whose value creation still rested heavily on physical, bulky output. Not unexpectedly, as goods and services have moved across borders, the necessity to finance them has increased dramatically. But what is particularly startling is how large the expansion in cross-border finance has become relative to the trade it finances. To be sure, much cross-border finance supports investment portfolios, doubtless some largely speculative. But at bottom, even they are part of the support systems for efficient international movement of goods and services. The rapid expansion in cross-border banking and finance should not be surprising given the extent to which low-cost information processing and communications technology have improved the ability of customers in one part of the world to avail themselves of borrowing, depositing, or risk management opportunities offered anywhere in the world on a real-time basis. These developments enhance the process whereby an excess of saving over investment in one country finds an appropriate outlet in another. In short, they facilitate the drive to equate risk-adjusted rates of return on investments worldwide. They thereby improve the worldwide allocation of scarce capital and in the process engender a huge increase in risk dispersion and hedging opportunities. But there is still evidence of less than full arbitrage of risk-adjusted rates of return on a worldwide basis. This suggests the potential for a far larger world financial system than currently exists. If we can resist protectionist pressures in our societies, in the financial arena, as well as in the interchange of goods and services, we can look forward to the benefits of the international division of labor on a much larger scale in the 21st century. What we don't know for sure but strongly suspect is that the accelerating expansion of global finance may be indispensable to the continued rapid growth in world trade in goods and services. It is becoming increasingly evident that many layers of financial intermediation will be required if we are to capture the full benefits of our advance in finance. Certainly, the emergence of a highly liquid foreign exchange market has facilitated basic foreign exchange transactions, and the availability of more complex hedging strategies enables producers and investors to achieve their desired risk positions. This owes largely to the ability of modern financial products to unbundle complex risks in ways that enable each counterparty to choose the combination of risks necessary to advance its business strategy and to eschew those that do not. This process enhances cross-border trade in goods and services, facilitates cross-border portfolio investment strategies, enhances the lower cost financing of real capital formation on a worldwide basis, and hence leads to an expansion of international trade and rising standards of living. But achieving those benefits surely will require the maintenance of a stable macroeconomic environment, an environment conducive to stable product prices and to maintaining sustainable economic growth has become a prime responsibility of governments and, of course, central banks. It was not always thus. In the last comparable period of open international trade a century ago, the gold standard prevailed. The roles of central banks where they existed, and remember, the United States did not have one, were then often quite different from today. International stabilization was implemented more or less by automatic gold flows from those financial markets where conditions were lax to those where liquidity was in short supply. To some, myself included, the system appears to have worked rather well. To others, the gold standard was perceived as too rigid or unstable, and in any event, the inability to finance discretionary policy, both monetary and fiscal, led first to a further compromise of the gold standard system after World War I, and by the 1930s, it had been essentially abandoned. The fiat money systems that emerged have given considerable power and responsibility to central banks to manage the sovereign credit of nations, as Jim mentioned in his opening remarks. Under a gold standard, money creation was at the limit tied to changes in gold reserves. The discretionary range of monetary policy was relatively narrow. Today's central banks have the capability of creating or destroying unlimited supplies of money and credit. Clearly, how well we take our responsibilities in this modern world has profound implications for participants in financial markets. We provide the backdrop against which individual market participants make their decisions. As a consequence, it is incumbent upon us to endeavor to produce the same non-inflationary environment as existed a century ago if we seek maximum sustainable growth. In this regard, doubtless the most important development that has occurred in recent years has been the shift from an environment of inflationary expectations built into both business planning and financial contracts toward an environment of lower inflation. It is important that that progress continue and that we maintain a credible, long-run commitment to price stability. While there can be little doubt that the extraordinary changes in global finance on balance have been beneficial in facilitating significant improvements in economic structures and living standards throughout the world, they also have the potential of some negative consequences. In fact, while the speed of transmission of positive economic events has been an important plus for the world economy in recent years, it is becoming increasingly obvious, as evidenced by recent events in Thailand and its neighbors, and several years ago in Mexico, that significant macroeconomic policy mistakes also reverberate around the world at a prodigious pace. In any event, technological progress is not reversible. We must learn to live with it. In the context of rapid changes affecting financial markets, disruptions are inevitable. The turmoil in the European exchange rate system mechanism in 1992, the plunge in the exchange value of the Mexican peso at the end of 1994 and early 1995, and the recent sharp exchange rate adjustments in a number of Asian economies have shown how the new world of financial trading can punish policy misalignments, actual or perceived, with amazing alacrity. This is new. Even as recently as 15 or 20 years ago, the size of the international financial system was a fraction of what it is today. Contagion effects were more limited, and thus breakdowns carried fewer negative consequences. In both new and old environments, the economic consequences of disruptions are minimized if they are not further compounded by financial instability associated with underlying inflation trends. The recent financial turmoil in some Asian financial markets and similar events elsewhere previously confirm that in a world of increasing capital mobility, there is a premium on governments maintaining sound macroeconomic policies and allowing exchange rates to provide appropriate signals for the broader pricing structure of the economy. These countries became vulnerable as markets became increasingly aware of a buildup of excesses, including overvalued exchange rates, bulging current account deficits, and sharp increases in asset values. In many cases, these were the consequence of poor investment judgments in seeking to employ huge increases in portfolios for investment. In some cases, these excesses were fed by unsound real estate and other lending activity by various financial institutions in these countries, which in turn undermined the soundness of these countries' financial systems. As a consequence, these countries lost the confidence of both domestic and international investors, with resulting disturbances in their financial markets. The resort to capital controls to deal with financial markets disturbances of the sort a number of emerging economies have experienced would be a step backwards from the trend towards financial market liberalization, and in the end would not be effective. The maintenance of financial stability in an environment of global capital markets, therefore, calls for greater attention by governments to the soundness of public policy. Governments are beginning to recognize that the release of timely and accurate economic and financial data is a critical element to the maintenance of financial stability. We do not know what the appropriate amount of disclosure is, but it is pretty clear from the Mexican experience in 1994 and the recent Thai experience that the level of disclosure was at each time too little. More comprehensive public information on the financial condition of a country, including current data on commitments by governments to buy or sell currencies in the future, and on non-performing loans of a country's financial institution, would allow investors, both domestic and international, to make more rational investment decisions. Such disclosure would help to avoid sudden and sharp reversals in the investment position of investors once they become aware of the true status of a country's and a banking system's financial health. More timely and more comprehensive disclosure of financial data also would help sensitize the principal economic policymakers of a country to the potential emerging threats to its financial stability. Thus, as international financial markets continue to expand, central banks have twin objectives: achieving macroeconomic stability and a safe and sound financial system that can take advantage of stability while exploiting the inevitable new technological advances. The changing dynamics of modern global financial systems also require that central banks address the inevitable increase of systemic risk. It is probably fair to say that the very efficiency of global financial markets, engendered by the rapid proliferation of financial products, also has the capability of transmitting mistakes at a far faster pace throughout the financial system in ways that were unknown a generation ago, and not even remotely imagined in the 19th century. Today's technology enables single individuals to initiate massive transactions with very rapid execution. Clearly, not only has the productivity of global finance increased markedly, but so obviously has the ability to generate losses at a previously inconceivable rate. Moreover, increasing global financial efficiency by creating the mechanisms for mistakes to ricochet throughout the global financial system has patently increased the potential for systemic risk. Why not, then, one might ask, bar or contain the expansion of global finance by capital controls, transactions taxes, or other market-inhibiting initiatives? Why not return to the less hectic and seemingly less threatening markets of, say, the 1950s? Endeavoring to thwart technological advance and new knowledge and innovation through the erection of barriers to the spread of knowledge would, as history amply demonstrates, have large, often adverse, unintended consequences. Suppressed markets in one location would be rapidly displaced by others outside the reach of government controls and taxes. Of greater importance, risk-taking so indispensable to the creation of wealth would undoubtedly be curbed to the detriment of rising standards of living. We cannot turn back the clock on technology, and we should not try to do so. Rather, we should recognize that if it is technology that has imparted the current stress to markets, technology can be employed to contain it. Enhancements to financial institutions' internal risk management systems arguably constitute the most effective countermeasure to the increased potential instability of the global financial system. Improving the efficiency of the world's payment systems is clearly another. The availability of new technology and new derivative financial instruments clearly has facilitated new, more rigorous approaches to the conceptualization, measurement, and management of risk for such systems. There are, however, limitations to the statistical models used in such systems owing to the necessity of overly simplifying assumptions. Hence, human judgments based on analytically looser but far more realistic evaluations of what the future may hold are of critical importance in risk management. Although a sophisticated understanding of statistical modeling techniques is important to risk management, an intimate knowledge of the markets in which an institution trades and of the customers it served is turning out to be far more important. In these and other ways, we must assure that our rapidly changing global financial system retains the capacity to contain market shocks. This is a never-ending process that requires never-ending vigilance. Thank you very much. It's been a pleasure being with you this morning.